2025, and the air on Wall Street is electric, buzzing with a hysteria that feels terrifyingly, painfully familiar. We are watching the single largest accumulation of financial risk in the history of the American economy, and nobody seems to be blinking. The world is if now engaged in a spending spree that defies all logic, all reason, and all historical precedent. In a single year, the biggest tech companies in America are spending $400 billion on artificial intelligence. This is not a typo. This is not a typo. This is not a projection. This is the reality of the current moment. Microsoft, Amazon, Google, and Meta are locked in a desperate, frantic race to build data centers that are large enough to cover the enterprise. They are borrowing silicon chips as if the world is ending tomorrow. They are signing energy deals worth hundreds of billions of dollars with companies that do not even have stay. You see, I have lived on this earth for 95 years. I have traded through wars, through recessions, through booms, and through busts. And if those 9.5 decades have taught me one simple, unbreakable truth, it is this: when you see the entire crowd running at full speed in the same direction, you had better look behind you to see what is chasing them. Because more often than not, they are not running toward a pot of gold. They are running toward a cliff. The artificial intelligence revolution is real. I will not deny that. But what is happening in the financial markets right now is not investing. It is speculation dressed up in a three-piece suit. And history has a brutal, unforgiving way of punishing speculation, no matter how smart, how wealthy, or how invincible the people involved think they are. Let us take a journey back in time. Let me take you back to 1999. I was sitting in my office in Omaha, surrounded by internet companies that possessed no profits, no tangible products, and in some cases, no business plans whatsoever. Yet, these companies were trading at valuations that would make your head spin. We had Petch.com, a company whose entire business strategy revolved around a sock. eBay is a social network site started by two college students with $15,000, which saw its stock price jump 606% on its very first day of trading. Never mind that they had zero revenue. Never mind that they had no path to profitability. The market did not care about facts. And back then, the story was that the internet changed everything. You know what everyone said about me back then? They said Warren has lost his touch. They whispered that the game had passed me by. They said the old man from Omaha is finished, that he is a dinosaur a young venture capitalist brimming with arrogance, a man who could not have been more than 30 years old, looked me in the eye and told me I was making the biggest mistake of my career by refusing to invest in internet stocks. He leaned across the table and said, "Warren, this time is different. The internet changes the laws of business." Well, that young man was half right. The internet did change everything. It revolutionized communication, commerce, and culture. But he was dead wrong about the other part. It did not change the laws of economics. It did not change the fact that a business must invent $10 billion of wealth evaporated into thin air. That young venture capitalist, the last I heard of him, he had lost his firm, lost his fortune, and went back to working at his father's car dealership. Now fast forward to today, 2025. Nvidia has just hit a market capitalization of $5 trillion. $5 trillion for a company that designs chips. OpenAI, $500 billion. That is $500 billion for a private company. This valuation exists despite the fact that they are posting only $13 billion in projected revenue for 2025. Why? That is, do the math together. They have committed to spending $300 billion with Oracle over the next 5 years. That means they will need to spend $60 billion a year on computing power alone, while bringing in only $13 billion. You cannot spend $60 billion to make $13 billion and call it a business. You call that a charity case, or you call it a disaster, but here is what really keeps me up at night. It is not just the valuations, it is the circular financing. This is the dirty little secret that nobody on television wants to talk about. OpenAI then turns around and uses that very same money to buy chips from Nvidia. Oracle builds massive data centers that it has not finished. Yet financed by money that opened exactly what we saw in the late 1990s with the telecom bubble. Back then, the telecom companies like Global Crossing and Level 3 Communications were laying fiber optic cables across the oceans at a breakneck pace. To boost their sales, they started lending money to their own customers to buy their services. Sure, it was a perpetual motion machine of money until the credit dried up. When the bubble finally burst, it was catastrophic. 4 years after the peak, 85% to 95% of that fiber optic cable was still sitting dark in the ground. Corning, the world's largest producer of optical fiber, watched its stock crash from $100 down to one single dollar. I did not invest in any of those companies back then, not because I am smarter than everyone else, but because I simply did not understand how they were going to actually make money. If I cannot understand the business model on a single piece of paper, I will not invest in it. That is what I call my circle of competence. I have spent 70 years staying strictly inside that circle, and it has saved me from ruin more times than I can count. You might ask, but Warren, didn't you miss out on the internet? Boom, sure I did. Well, Amazon, Google, Microsoft, all of them went on to become giants, and I missed the early ride. And you know what? I am perfectly okay with that, because for every Amazon that survived and thrived, here is the thing about bubbles that most people fail to understand. They are almost always built on a foundation of truth. The internet was revolutionary. Camp computing did transform business. But the question is never whether the technology is real. The question is whether the price you are paying for that technology makes any sense. Man, this year around 2000, the Nest reached a price-to-earnings ratio of 200. Read that again. 200 times earnings. Today, we are not quite at that level of insanity, but we are getting close. But the devil is in the details. 80% of the market retailers are concentrated in just a handful of technology stocks, the so-called Magnificent Seven, NVIDIA, Apple, Microsoft. They account for 75% of the total returns of the entire index. That is not a healthy market. Was resting on a very narrow cuts, resting on a very narrow base. The economic data just keeps getting more concerning the deeper you look. According to recent research, capital expenditures related to artificial intelligence spending is the primary driver of economic growth. In America right now, not consumer spending, not manufacturing, not business, single technology trend is propping up the entire economy. And then again in 1999 with tech stocks, both times ended in tears, both times ended with investors losing decades of savings. The venture capital numbers are even more alarming. Nearly 64% of all United States venture capital in the first half of 2025 went solely to AI. For comparison, internet deals only comprise about 25% of venture capital investment at the absolute peak of the dot-com boom. We currently have more than $100 million and 498 AI unicorns worth more than $1 billion each. In fact, 70% of funded AI sites are still losing money every single month, but their valuations keep climbing because everyone is afraid of missing out. We do not call it investing, we call it gambling. My partner, Charlie Munger, God rest his soul, used to tell me that it is waiting that helps you as an investor, and a lot of people just cannot stand to wait. Charlie understood something that most people on Wall Street never learned. Making money in the stock market is about patience, not activity right now. I look at companies spending 22% as Berkshire. Meta is planning a single data center that would require over 2 gigawatts of power. That is enough electricity to power a small city, just to house 13 million NVIDIA GPUs, and I have to train AI models that might be obsolete in 2 years. To compete in a race where everyone is spending billions to maybe possibly hopefully generate returns sometime in the distant future. This is not investing, this is speculation. On steroids, the uncomfortable truth that nobody wants to hear is that for all this massive spending to pay off, AI companies need to what? Right now, they are bringing in about $20 billion. That implies a 100-fold increase in revenue, a 100-fold increase I have been in this business since 1951. I have never, and I mean never, seen an industry scale. Let me tell you something about numbers. They are stubborn things. You can dress them up, put lipstick on them, call them adjusted EBITDA or AI adjusted revenue. But at the end of the day, a business either makes cold hard cash or it does not. Microsoft, Amazon, Google, and Meta are projected to spend a combined $364 billion in their 2025 fiscal years alone. These are not startup companies gambling with venture capital any. These are the largest drunken sailors on shore leave. Microsoft just raised its capital guidance to over $120 billion for 2025. Amazon is spending $100 billion. Google bumped its forecast from $75 billion down top to stop. Microsoft to bear $120 billion in capital spending is 7 times what they spent just 5 years ago. 7 times. That is not growth. That is a complete and total transformation of their business model into a capital-intensive heavy industry. They are betting the farm that it works. Entitled to artificial intelligence reaction regional business. Microsoft reported that their AI services had reached a $13 billion annual run rate. That sounds impressive in a headline until you realize they're But Warren, you might say this is about the future. They are investing for long-term gains, and you're just too short-sighted. And you are right, it is about the future, but there is a difference between investing for the future and speculation. The difference is simple. Can you reasonably predict the return on that investment? In the dot-com era, companies like Global Crossing spent $15 billion building a worldwide fiber optic network. The logic was impeccable. Internet traffic was doubling every 100 days, so we would need massive capacity. The thesis was flopped. Today, AI infrastructure build-out is happening even faster and at an even larger scale. The parallel isn't just similar. It is practically identical. And here is something that should terrify anyone who understands market history. This spending is being funded $7 billion in off-balance sheet financing. These companies are taking on leverage at the same time they are making massive uncertain bets on technology that might not pay off for years. If ever I have lived through enough credit cycles to know that debt magnifies losses. When things are going well, debt makes you rich faster, but when things turn, debt is what kills you. I remember in my early days, I made the mistake of buying Berkshire Hathaway itself because I was angry at the management. It was a textile company, a cigar butt stock. Cheap enough that I thought I could get one more puff out of it. That investment, which I made out of emotion rather than reason and profitably cost me. But decision I ever made. I have spent decades trying to explain to people why buying a struggling textile company was such a monumental error. The lesson is this: even smart people make dumb decisions when they let emotion override analysis. And right now, the emotion in AI investing is pure fear. Fear of missing out. Fear that if you do not invest billions immediately, your company will become a recipe for good capital allocation. That is panic dressed up as corporate strategy. Let me give you some more uncomfortable numbers. OpenAI is on track to lose several $billions this year. Their costs for computing power are so high that they need to continually raise prices while simultaneously trying to reduce the computational expense of their model. Our own, the entire AI startup ecosystems is built on the assumption that eventually, someday, the magic will happen. In the dot-com era, we had something called the burn rate, how fast the company was spending its cash reserves. Analysts would calculate how many months of runway a startup had before it crashed. Today, we are seeing the exact same dynamic with AI companies. The only difference is that now They have deeper pockets backing them. Spending more than you make is not a sustainable business model. Ray Dalio recently said that he sees bubble conditions forming, but that bubbles do not pop until monetary interest rate policy has been accommodative, making capital cheap and easy to access. Poe for when the economy slows and investors start demanding profits instead of promises. That is when we will see who is swimming naked, as I like to say. And right now, I suspect there are a lot of naked swimmers in the AI pool. Here's another parallel that keeps me up at night. At the peak of the dot-com bubble, the top 10 stocks made up about 27% of the S&P 500 total weight. Today, the top 10 stocks represent 39% of the index. That is not just concentration. Or more likely, when these stocks correct, they will not just drag down the technology sector. Okay, with them, your pension fund, your retirement account, your index funds, you're all loaded up with these same companies. The average investor thinks they are diversified because they own an index fund, but they are really making a massive concentrated bet on 10 companies, most of which are spending unsustainable amounts on AI infrastructure. And here is the thing that really bothers me. We know how the story ends because we have seen this movie before. After the dot-com crash, it took the Nasdaq 15 long years to get back to its March 2000 peak. An entire generation of investors learned the hard way that trees do not grow to the sky. But the most concerning aspect is not the spending, it is the revenue. According to recent research, Big Tech has invested about $560 billion in AI infrastructure over the past 2 years. The combined AI-related revenue from Microsoft, Meta, Tasty, Bing will pay off eventually. Sure, but all of it, not a chance. MIT recently did a study that found 95% of AI pilot projects failure rate. That is, despite more than $40 billion in generative AI and $40 billion. What really concerns me is the psychology behind all this spending. It is not based on careful analysis of returns. It is based on fear. Fear that if you do not invest now, you are doomed. That is the same psychology that drove the housing bubble, the tulip mania, and every other financial disaster in human history. In my shareholder letter from the year 2000, I wrote about how investors were like Cinderella at the ball. They knew that staying too long would turn everything to pumpkins and mice, but they hated to miss a saint. Today, we are seeing the exact same behavior, just with artificial intelligence. Swing, right now the music is full swing, right now the music is playing, the champagne is flowing, and everyone is having a great time, but I have been to enough poetry. But the answer is simpler than they think. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. It sounds simplistic, but think about what it really means. If you lose 50% of your money, you need a 100% gain just to get back to even. That is not a game you want to play. Okay, and right now with AI valuations where they are, I see a lot of people playing that exact game with their life savings. Let me tell you about a study I came across recently. A researcher named Kai Wu examined major capital expenditure cycles throughout history. Railroads in the 1860s, automobiles in the 1900s, radio in the 1920s. You know what he found in every single case? The companies that aggressively grew their balance sheets through massive capital spending underperformed their conservative peers by an average of 84%, so you don't miss it. The aggressive spenders lost to the conservative companies by 84% per year over a decade. The patient investor beats the aggressive spender almost every single time. Why does this happen? It is not complicated. When companies race to build capitals or AI data centers, they create massive overcapacity. Supply exceeds demand, prices fall, returns evaporate. Companies are building AI infrastructure at an unprecedented pace, all betting the demand will be there to justify the investment. But what if it is not? What if AI adoption is slower than everyone thinks? Obsolete. They invest when the price is significantly below intrinsic value, giving you a cushion against mistakes. Or bad luck, today AI valuations have absolutely no margin. Usually something goes wrong. Sometimes everything goes wrong. That is why you need a margin of safety. Let me give you a concrete example of what I am talking about. Cisco Systems was the darling of the dot-com era, the company selling the picks and shovels of the internet revolution. At its peak in March 2000, Cisco had a market cap of $555 billion, making it briefly the most valuable company in the world. The stock traded at a price-to-sales ratio of 35 and a P/E ratio above 200. Everyone said Cisco was different, pie in the ski startup. And they were right. Cisco was different. It survived the crash. But the stock, it fell 86% from its peak, even today, 25 years later. Cisco trades below its year 2000 high. For inflate now, look at it etting for inflate now we're capped. Is NVIDIA a good company? Absolutely. Is it revolutionizing computing? Yes. Does it have real revenue and real profits? Yes, to both. But is it worth $5 trillion? That is where I have my doubt. Makes sense. Everything has to go perfectly. AI demand has to go perfectly. AI demand has to continue growing exponentially. No competitive threats can its pricing power. Technological changes cannot obsolete current chip designs. The global economy has to remain strong. That is a lot of things that all have to go right. And in my experience, when you need everything to go right, something usually goes wrong. Charlie Munger used to tell me, all I want to know is where I am going to die, so I will never go there. He was talking about avoiding obvious mistakes, and the most obvious destroyer. I could buy the best house in America, but if I pay 10 times what it is worth, it is a bad investment. The same principle applies to stocks. Price matters, value pragmatics. Does not change the fundamental mathematic. Crowd is very enthusiastic about AI, but so did the internet, and that did not prevent the dot-com crash from wiping out trillions in wealth. Here is something most people do not realize. Even if you are right about the technology, you can still lose money if you pay too much. I was wrong about the internet. Their impact. It changed the world more than even the optimists predicted. But at its peak, you lost money for 15 years, even though the internet transformed society. Being right about the future and making money in the stock market are two different things. The difference is the price you pay. Let me tell you about another historical parallel that has been on my mind. In the 1920s, there was enormous enthusiasm about radiology for as a revolutionary technology. Well, the first time in human history you could transmit information through the air. Radio stocks soared, everyone wanted in. By 1932, Archia had fallen to $18. It took 27 years for Archia to get back to its 1929. Radio did change the world. The technology was revolutionary or 90s prices that could not be justified by any reasonable projection of earnings. Today, I see the exact same pattern. Investors are paying extraordinary prices because they believe AI will change everything. They are probably right that AI will change everything, but that does not mean current prices make sense. One of the most valuable is a voting machine in the short term. Right now, the vote is strongly in favor of AI stocks, but eventually the market will weigh these companies. It will measure their actual earnings, their return on capital, their competitive position, and when that weighing happens, I suspect many current valuations will be found wanting. Spending on a core, they risk falling behind Google. If Google slows down, they risk losing to Amazon. So everyone keeps spending, even though collectively they are probably overbuilding capacity. It is a classic prisoners to blink. But someone always blinks eventually. Maybe it is an economic slowdown that forces capital discipline. Maybe it is a new technology that makes current investments obsolete. Maybe it is simply investors demanding profitability instead of growth at any cost, whatever trends at the dimaps about a major. When though they do not know when, nobody does. Anyone who tells you they can time the market is lying to you or to themselves. But I know it will happen because it always happens. Bubbles always pop. Gravity always wins. The question is whether you will be positioned to survive it and perhaps even benefit from it. So where does that leave us? Look, I am not saying AI is worthless. I am not saying these companies won't succeed. What I'm saying is the current valuations embed expectations that require perfection. You are setting yourself up for disappointment. My approach has not changed in 70 years, and it will not change now, Mrs. I invest in businesses. I understand that prices that make sense with a margin of safety. Right now, AI stocks meet exactly none of those criteria for me. Can I prove I am right? Number maybe this time really is different, but I am 95 years old. And I have heard this time is different, more times than I can count. And every single time, it was not different. The fundamental laws of economics and human nature do not change just because the technology does. Percent of your money, you need a 100% return to break. Even that is mathematics, not opinion. So my first goal is always capital preservation. Right now, the safest thing Berkshire can do is what we are doing. Sitting on over $300 billion in cash and short-term securities. Wow. They say I am missing opportunities. Maybe I am, but I sleep well at night knowing that when this market corrects, and it will correct, Berkshire, we'll have the capital to take advantage of the opportunities that emerge. We will be able to buy wonderful companies. But it is what has worked for me for 7 decades, and I see no reason to change. Now, the AI revolution is real. The bubble is also real. Both things can be true at the same time. Your job as an investor is not to predict which AI company will win. Your job is to protect your capital and position yourself to profit regardless of what happens. 那些让你一辈子穷 that is to be patient, be selective, and be willing to sit on cash when you cannot find investments that meet your criteria. As I've said before, the stock market is designed to transfer money from the active to the patient. Right now, there is a lot of activity. There is not much patience. While I know which side of that equation I want to be on, the AI bubble will burst. I do not know when. And I do not know what will trigger it, but I know it will happen because every bubble in history has burst. Look, I will end with this thought. 25 years ago, people called me a dinosaur for not investing in the internet. Stocks! They said I was too old, too conservative, too stuck in the past. Then the market crashed and Berkshire's stock price doubled while the Nasdaq lost 78% of its value. Oh, suddenly, I wasn't a dinosaur anymore. I was a genius. But I didn't change the market. The same thing is about to happen with AI. Right now, I am the old man who does not understand artificial intelligence. But in a few years, maybe sooner, maybe later, we will look back at 2025, the same way we look back at 1999. We will shake our heads and wonder how people paid such crazy prices, preserved their captors, who preserved their capital, who stayed patient, who refused to get caught up in the mania. They will be the ones positioned to profit from the opportunities. That is where I plan to be. I hope you will join me there. If you found this analysis to Sarah, be sure to subscribe for more content like this. Thanks for watching.